The new Black Swan has arrived now. Welcome to the first true Black Swan event for the market since COVID-induced meme stock craze. Silicon Valley Bank's collapse on Friday is the second largest bank failure in the U.S. Treasury Secretary Janet Yellen said early Sunday there would be no federal bailout for the striking bank, and she held on true to those words by the end of the day. A joint statement from Yellen, Fed Chief Jerome Powell, and FDIC Chair Martin Grunberg said depositors would have access to all of their money today from Silicon Valley Bank. The same goes for Signature Banks, which was closed on Sunday. No losses will be borne by the taxpayer. Any losses to the depositors' insurance fund to make uninsured depositors whole will be recouped by a special assessment on banks, the statement said. Now, shareholders in this bank will not be protected. Senior management has been removed. The Fed added it will make available additional funding to eligible depository institutions to help ensure they can meet depositors' needs. Wall Streeters are likely still to brace for more contagion despite the extraordinary measure, while at the same time trying to convey messages this is not Lehman Brothers circa 2008-2009. Yes, there are a couple other banks that have some tech concentrations that pose some risk, but SVB was extreme in its courting of large accounts and perks. And they will try to tell you this is a risk to the entire system, but it is not there. So the big banks are incredibly well capitalized, and the market even told you that on Friday with JP Morgan, Citibank, or Bank of America and Wells Fargo all having uneventful days in the market. This would be a one or possibly two off situation where a bank made a mistake with buying longer-term mortgages to push for yields, and with a concentrated deposit base that was extremely loyal until they were not. One long-time fund management told Yahoo Finance. Now let's look at some of the companies known to be impacted so far beside banks. The first one we have is Roku. Now the streaming player had $487 million, or 26% of its $1.9 billion in cash at Silicon Valley Bank. At this time, the company does not know to what extent the company will be able to recover the cash and deposit at SVB, Roku said in a disclosure. The next one we have is Etsy. Now the e-commerce company is reportedly delaying some payment to sellers as it used to use the SVB to facilitate disbursement. Now at Etsy, supporting our sellers is our highest priority, and we understand how important it is for these small businesses to be able to receive their funds when they need them. We recently experienced a delay in issuing payment to some sellers related to the unexpected collapse of Silicon Valley Bank. Our teams have been working around the clock to implement a solution, and we expect to pay sellers via other payment partners within the next several business days, and Etsy spokesperson told Yahoo Finance via email. The next one we have is Rocket Lab. Now, space startup Rocket Lab disclosed it had about $38 million on deposit at SVB, or 7.9% of its total cash. Now, 92% of Rocket Lab's cash and cash equivalent are held by other financial institutions, so we are not facing a liquidity issue and do not expect it to impact our operations at this time. The process for recovering all or portions of Rocket Lab's fund with SVB will be a highly regulated one and will play out over time, and will monitor its progress closely, a spokesperson told Yahoo Finance by email. Now the next one we have is Roblox. Of Roblox Corporation's $3 billion of cash and securities balance as of February 28, 2023, approximately 5% is held at Silicon Valley Bank. Thus, regardless of the ultimate outcome and the timing, this situation will have no impact on the day-to-day operations of the company, the Metaverse player said in a disclosure. Now, the emerging themes to watch for now. The Fed's next move. The SVB situation has cast Fed's fresh doubt on whether the Fed will raise interest rate by 25 basis points or 50 basis points at its policy meeting next week. Turmoil in bank stocks must make the Fed a little more cautious. Core banks look strong and well hedged, but stress on regionals is a sign monetary tightening is impacting the financial system with a lag via mark-to-market losses and toughening competition for the deposits, said Evercore ISI strategist Krisha Guhu. Now, the longer-term impact to banks, it's unclear how SVB will shape future returns for investors in banks, if it will at all. But there is a chatter the fallout will make it difficult for larger banks to get capital relief in time of stress. Moreover, regulators could even support increasing capital regulations. Both wouldn't be great news for bank investors. So brace yourself, fellow investors, for something serious is coming.